Place your bets, ladies and
Well, they have
gentlemen.
been around since the 1990s, but do you know what exchange-traded funds are? They're better known as ETFs, and they have become a popular option for investors for many reasons. On tonight's Money Talks, we explore ETFs. The world's first ETF was created in Canada in 1990, transforming the investment landscape and offering the advantages of pooled investing and trading flexibility. But what are they?
Exchange-traded funds, or ETFs, are pooled investment vehicles that offer a diversified portfolio with a single investment, as opposed to traditional open-end mutual funds that you buy directly from the company that issues the mutual fund. ETFs are bought and sold on a stock exchange directly from other investors.
And since they are a different product, ETFs have some potential benefits over traditional mutual funds. I'll let certified financial planner Neil Vinoy explain.
ETFs, because of the way they're created and traded, they're much more tax efficient than most mutual funds. ETFs generally offer lower expense ratios, which is the ongoing cost that you'll pay to hold that investment. Since most ETFs follow an index, it's easy to find out exactly what that ETF holds. Mutual funds are required to report their holdings, but there can be some delay between when you buy it and then the next time they report what they actually hold in that mutual fund. ETFs can be bought and sold all day long, unlike traditional mutual funds that are only sold at the end of the day. So when you buy an ETF, you know exactly what you're going to pay per share when you place that trade.
But just like almost anything in life, there are some downsides that you'll want to be aware of before buying in.
Traditionally, you'd have to pay a commission to buy and sell an ETF, and that can add up. But nowadays, most brokerage firms offer free trading, so that isn't a problem anymore. If an ETF doesn't have a lot of liquidity, there can be a large spread between the price you pay to buy and the price you pay to sell. So be careful, make sure there's a narrow spread, and it's a good idea to use limit orders when trading so you know exactly what you'll be paying if you buy or receiving if you sell.
And just a reminder that the single biggest risk in ETFs is market risk. Like a mutual fund or a closed-end fund, ETFs are only an investment vehicle, a wrapper for their underlying investment. So if you buy an S&P 500 ETF, let's say, and the S&P 500 goes down 50%, well, nothing about how cheap or how tax efficient or transparent an ETF is going to help you at that point. So buyer beware. Lindsay?